So good morning, good afternoon, good evening, whenever you're watching this. So we are going to do a summary, a quick recap of the basics of income tax. So first up, you're going into the area of residency. Now, why do you do a residency test? To know if the person is UK resident or non-UK resident. There are 3 steps for this. Step 1 is called automatic non-UK residence test. Automatic non-UK residence test has 3 criteria. And what are they? So let's have a look at the 3 criteria. Now, this is the automatic non-UK residency test. These are the 3 conditions. I'll tell you what the 3 conditions are. So we should check whether the person is in tax year for less than 16 days or less than 46 days and was not UK resident in any of the previous 3 tax years, less than 91 days and works full-time overseas. Now, please pay attention that when we apply the non-UK residency test, any one of the conditions need to be satisfied, not all 3. If any one of the conditions is satisfied, this person is non-UK resident. If none of these conditions are being satisfied, we go to step 2. And what is step 2? Now, the second step is automatic UK residence test. So let's look at the conditions for automatic UK residence test. Now, automatic UK residency test has these 3 conditions. What are the conditions? A person must be in the UK for at least 183 days. At least 183 days, which means a minimum of 183 days in the tax year. And the only home is in the UK and they work full-time in the UK. Now, when it mentions only home, they can't have more than one home. If they have more than one home, then that condition is not satisfied there. Now, same thing when for step 2, only any one of the conditions are satisfied. If any one of the conditions are satisfied, this person is automatic UK resident. If this test also is not being satisfied, we go to step 3, which is sufficient ties test. Okay. Now, what is sufficient ties test? Sufficient ties test is whereby there are 5 conditions which we look into. These are the 5 conditions. We have to see if any of these conditions, how many of these conditions are being satisfied. Okay. So step 1, step 2 doesn't work. We go to step 3. This is step 3. So you can look into the conditions: spouse or minor child in the UK, house in the UK which is used in tax year. Now, even if it's a rented house, that's also counted. And the next one is in UK for at least 90 days in the previous 2 tax years. That is 3 months. So it should be in 1 tax year, not in 2 taxes total, in 1 tax year. Now, more time in UK than in any other country doing substantive work. Substantive work means this person is either employed or self-employed. Now, if a person satisfies these ties, when you are using the sufficient ties test, how do you use it? Just figure out from the question how many ties are being satisfied, and the next thing is you use this tax table to find the answer. From the question, find out how many days and whether the person is resident or previously resident, and you'll be able to get the answer. Now, some more things. Tax year 2021-22, it runs from, so let's just look into some of those details. Runs from 6/4/21 to 5/4/22, right? Taxable income is equal to your net income minus personal allowance. Now, net income is total income minus qualifying interest. What is qualifying interest? Now, remember, this is interest being paid, not received. If you take a loan for any of these given reasons, then the interest we pay on it is called qualifying interest. And this qualifying interest is what we reduce from the total income, right? Now, this is likely to come up in MCQs as well. So please take note of that. And there is a category of tax exempt income, which means there are certain income for which there is no income tax liability. So let's have a look at that. Now, this is the tax exempt income. Now, individual savings accounts, savings certificate, premium bonds, and child benefit. Now, individual savings account up to £20,000, you're able to keep tax exempt income. Any interest or dividends you receive from the savings account are fully tax free. Interest is sometimes called profit. Now, when it comes to savings certificate, also any income from there, the savings account, it's actually exempt. And premium bonds are like lottery, and any of the prizes you get from this premium bond is fully tax free. And child benefit also, if your ANI is below £50,000, the amount is fully tax free. Now, the personal allowance amount is 12,700. Okay. And your PA is reduced when your adjusted net income is greater than 100,000. Okay. When your adjusted net income is greater than 100,000. Now I'll just, it's not 12,700, sorry. I just saw that now. It's 12,570. Okay, it's 12,570. Your PA is 12,570. And your ANI is net income minus gross gifted, minus gross gifted, minus gross personal pension contributions. That is what your adjusted net income is. Okay. Now, why do you need adjusted net income? For many reasons. For determining whether you're getting the full P of 12,570, and also to find out the child benefit tax charge, which we'll be talking about in some time. Now, marriage allowance. What is marriage allowance? Couples who are basic rate taxpayers, one person is able to transfer 10% of their PA to the other person. Now, what is the effect on the transferor and the recipient? For the transferor, the PA gets reduced. Okay, PA gets reduced by 1260, and for the recipient, income tax liability is reduced by pound 252. Okay, pound 252. Right. Now, when it comes to charity and personal pension contribution, what is it that you need to do? How does it affect? First of all, you had to gross it up. How much ever it is that you're paying, multiply by 100 by 80 is a gross of figure. And this figure, your basic rate band, your higher rate band gets extended by these figures. And that is how you're able to save tax when it comes to your gifted and personal pension contribution. Now, child benefit, usually when the UK government gives child benefit, it is tax free. But the situations in which it is tax free is, so child benefit is exempt if ANI is less than 50,000. If ANI is less than 50,000. If ANI is between 50 and 60,000, I'll give you one example. How is the charge calculated? Let's say that the value of ANI is, 58,000, and this person got a child benefit of pound 1,000. So how is the percentage calculated? The percentage, that is how much of 1,000 is actually coming under income tax liability. So how do we calculate that? 58,000 minus 50,000 divided by 100, which gives us 80%. Okay, which gives us 80%. So 80% of 1,000 is something you have to add to your income tax liability. If your ANI is greater than 60,000, then the entire amount of child benefit, is taxable. Entire amount of child benefit is taxable. So always have in mind that if your ANI is below 50,000, child benefit which you received is fully tax free. If it is between 50 to 60, a percentage is chargeable, but if it's greater than 60,000, the entire amount is taxable. Right. Now, there's another scheme called the accrued income scheme. So let's talk about the accrued income scheme. Let's talk more about the accrued income scheme. Okay, so what exactly is this accrued income scheme? Let's discuss for a bit. When it comes to the accrued income scheme, how you usually do it is, be the seller or the buyer, you have to accrue to them. So whoever receives it, maybe the seller is receiving it or maybe the buyer is receiving it. However it may be, you have to accrue the income to whoever it is that is getting the particular amount of interest. If the seller is actually selling it during 10 months and the buyer is getting 12 months of interest, then what happens is 10 months worth interest will be shown for the seller and only 2 months worth interest will be shown for the buyer. Okay. Now, if you want to get a proper idea about this, you can go and check out 2 MCQs from your PPP revision kit, which is specifically mentioned for accrued income. Now, another area which we need to focus on with regards to this particular, your income tax liability chapter is another aspect is, jointly held properties. The jointly held property, what happens is, husband and wife are jointly holding a property. The property income they receive from that is by default split in the 50/50 basis. If it's 50,000 rent, then it's shown 25,000 in the husband's name and 25,000 in the other spouse's name. Okay. Now, unless they make a claim, they show it in a specific percentage. If nothing is mentioned, by default, it is shown at 50:50%.